Imagine you're walking down the street and someone offers you a game. Flip a coin. If you guess correctly, you double your money. If you guess wrong, you lose everything you bet. At first, this sounds like an incredible opportunity. Start with $100. Win once, and you have $200. Win twice, and you have $400. Win 3 times, and you have $800. After only 14 wins in a row, you would have more than $1 million. Sounds easy, right? Unfortunately, the probability of winning 14 coin flips in a row is only about 0.006%. So the real question isn't, how can we win? The real question is, how can we avoid going broke before we reach our goal? Today, we're going to test 3 different strategies and use thousands of simulations to see which one gives us the best chance of growing our money.
Instead of betting all of our money on one side, we split our money between both sides. For example, $55 on heads, $45 on tails. If the larger side wins, our bankroll increases. If the smaller side wins, our bankroll decreases. This creates a trade-off. We sacrifice some growth in exchange for reducing risk. The next question is, how should we manage our money after we win and after we lose?
Before we discuss the different strategies, we need to define what happens when we win. This winning rule is exactly the same for every strategy in this experiment. Whenever the larger side wins, we take the new bankroll and split it using the same ratio again. For example, start with $100. Split $55 and $45. If the $55 side wins, our bankroll becomes $110. Now, we do not keep betting $55. Instead, we apply the same 55-45 ratio to the new bankroll. 110 times 55% equals $60.5. 110 times 45% equals $49.5. Our next bet becomes $60.5 and $49.5. Suppose the larger side wins again. Our bankroll becomes $121. Again, we split using the same ratio. 121 times 55% equals $66.55. 121 times 45% equals $54.45. Notice what is happening. Every win increases the size of future wins. This is called compounding.
The first win earned us $10. The second win earned us $11. The third win would earn even more. Economists and investors often describe compounding as the engine of wealth creation. When gains are reinvested, growth becomes exponential instead of linear. This is why long-term investors care so much about percentage returns. A portfolio that grows by 10% each year doesn't earn the same number of dollars every year. The gains themselves begin generating gains. The same principle drives retirement accounts, stock market investing, and business expansion. In our coin flip experiment, compounding is the engine that drives growth in all 3 strategies. The only difference between the strategies is what happens after we lose.
Let's say we start with $55 and $45. Now imagine the smaller side wins. Our bankroll falls from $100 to $90. Instead of recalculating the ratio, we preserve the original main position. We keep $55 on the main side. The remaining $35 become the hedge. So the next round becomes $55 and $35. If the smaller side wins again, our bankroll becomes $70. Again, we preserve the main position. Now we bet $55 and $15. The idea is simple. Protect the main position for as long as possible. Allow the hedge side to absorb the losses. Eventually, the bankroll becomes too small to support the main position. At that point, we enter recovery mode. We set the remaining bankroll aside and attempt to rebuild. This strategy focuses on preserving strength during losing streaks. In economic terms, this is a form of capital preservation. Many pension funds, insurance companies, and conservative investors follow a similar philosophy. Their first objective is survival. Growth comes second. Because if you lose too much capital, future opportunities become much harder to exploit. The second strategy uses a completely different philosophy. Instead of protecting the main position, it focuses on recovering losses immediately. Example, start with $100, split $55 and $45. The smaller side wins. Our bankroll becomes $90. We have lost $10. Instead of returning to the ratio system, we attempt to recover that loss. We place $10 on one side. If we win, 90 plus 10 equals $100. The loss is completely recovered. We return to the normal ratio strategy.
But if we lose, 90 minus 10 equals $80.
Now the total loss is $20. The recovery bet becomes $20. If that wins, 80 plus 20 equals $100. Recovered. If it loses, 80 minus 20 equals $60. Now the loss becomes $40. The recovery bet grows again. This process continues until the loss is recovered or the bankroll reaches zero. This strategy is much more aggressive. It attempts to erase losses immediately rather than absorbing them gradually. The logic is appealing because a single successful recovery can erase previous losses. But economists often warn about strategies that require increasingly large commitments after losses. The danger is that a long losing streak can exhaust available capital before recovery ever occurs. In other words, the strategy can work brilliantly until it doesn't.
The third strategy combines both ideas. First, it uses strategy 1. After a loss, it preserves the main position and reduces the hedge. This continues until the bankroll can no longer support the fixed main position. Only then does it switch to strategy 2. At that point, it begins direct loss recovery. In other words, strategy 1 acts as a shield. Strategy 2 acts as an emergency recovery system. The hybrid strategy attempts to balance survival and recovery. The question is, does it actually work?
To find out, we built a simulation. Starting bankroll, $100. Target bankrolls, $120, $130, $140, $150, $160, $170, $180, $190, and $200. Main side ratios, 51% through 70%. For every combination, we simulated thousands of games. For each strategy, we recorded the probability of reaching the target, the probability of going broke, and the best performing ratio. Let's look at the results.
The first result is exactly what we would expect. As the target increases, the probability of success decreases. Reaching $120 is relatively easy. Reaching $200 is much harder. Every additional step toward the target requires more successful flips, and more flips create more opportunities for losses. But the most important observation is the comparison between strategies. The hybrid strategy consistently remained near the top. It performed as well as or better than the individual strategies across most targets. This suggests that combining preservation and recovery is more effective than relying on only one method.
Next, let's examine the best ratio. For each target, we search for the main side percentage that produced the highest probability of success. Something surprising appears. The optimal percentage is almost never 70%, and it is rarely close to 50%. Instead, the strongest results consistently appear between roughly 55% and 63%. This tells us something important. Too little risk produces slow growth. Too much risk creates excessive drawdowns. Economists call this the risk-return trade-off. Higher risk may create larger gains, but it also increases the chance of large losses. Every investor faces this exact problem. Stay too conservative and wealth grows slowly. Taking too much risk and a bad streak can erase years of progress. The best performance comes from balancing growth and protection.
This is the most important graph in the entire experiment. We fixed the target at $200 and compared every ratio from 51% to 70%. Notice the shape of the curve. As the main percentage increases, success probability initially rises. Then it reaches a peak. After that, it begins to fall. This creates a clear sweet spot. For our simulations, the strongest region was between approximately 55% and 63%. The best performing configuration was around 63-37. Using the hybrid strategy, this ratio reached $200 in about 50.6% of simulations. That was the highest success rate observed. This result highlights another important idea from finance. Two strategies can have similar average outcomes while producing very different long-term results. Large losses are especially dangerous because recovery becomes increasingly difficult. The deeper the loss, the harder the comeback. This is why professional investors often spend as much effort managing downside risk as they do searching for returns.
One of the most important lessons from economics is that survival has value. If a strategy goes bankrupt, it never gets the chance to benefit from future opportunities. Economists sometimes refer to this as avoiding ruin. A strategy with slightly lower returns, but a much lower probability of bankruptcy can be superior in the long run. Why? Because staying alive allows compounding to continue working. Once your bankroll reaches zero, future opportunities no longer matter. The game is over.
The coin never changed. The probability of heads remained 50%.
The probability of tails remained 50%. The only thing we changed was how we responded to losses, and that turned out to be the most important decision of all. So the next time someone asks how to get rich from a coin flip, the answer isn't find a better coin, it's find a better way to survive. Because in gambling, investing, and business, long-term success is rarely determined by a single big win. It's determined by a combination of growth, risk management, and survival. The investors who survive market crashes can continue compounding. The businesses that survive recessions can benefit from future expansions. And in our coin flip experiment, the players who stayed alive the longest gave themselves the greatest chance to reach their target. In the end, wealth creation wasn't just about winning. It was about staying in the game long enough for compounding to do its work.